The information contained in this podcast is an expression of opinion and does not constitute investment advice. This is the Gold Money Podcast with James Turk, keeping you up to date with expert opinion on precious metals and the markets.
This is James Turk, and it's my pleasure to be speaking today with an old friend, Bob Prechter. Bob, I really want to thank you for joining me on this podcast. Got a couple of questions for you.
Sure.
I want to talk about inflation, deflation. You know, this is something you and I have spoken about many times over the past. I want to see if you're still holding to your deflationary views.
Very strongly. And I think we're seeing some of the fundamental and technical reasons both that are beginning to show deflation becoming a real threat again as it was in 2008. First of all is the impending collapse of this whole charade in Europe. The idea that Germany could hold all of the profligate countries from going under in terms of their IOUs. The Greeks don't want it. The Germans hate it. That whole dynamic is about to end. And I think from the technical point of view, we finally had our downturn in the stock market. Most stocks actually peaked a year ago in April of 2011, if you go by the New York Composite Index. But the blue chips dragged it up to sort of a double top here in 2012. I think the internals are absolutely terrible. The market has really gotten thin. As you know, volume was low and contracting for the entire 3-year period of the rally. So with this recent crack in May, I think that's a signal, which I've been waiting for, to indicate the kickoff for the second deflationary wave. We'll see.
Yeah. Are you expecting, though, that the ECB will intervene and come up with more long-term refinancing operation or other types of schemes and gimmicks, you know, to keep putting new money into the system to prevent a deflation?
Yeah, when I wrote Conquer the Crash, I said ultimately the central banks would have to give up because they're working in a credit system. If they were just dictators with a printing press and they could turn the crank and all we had was currency out there, that'd be different. But the U.S. government depends entirely on the validity of its bonds. The the Fed itself depends on the integrity of its assets. I don't think either of those entities are quite ready to go over the edge and simply start printing currency like flypaper. But I could be wrong, but I think the markets are telling me that this is emerging. I think the metals topped last year. The commodities topped last year at a lower high, by the way, than 2008. And usually when silver goes vertical on the upside and then drops 50%, there's no guarantees in life, but I would say that's a pretty good sign that an important reversal occurred. So when I look at commodities, I look at the metals, I look at the stocks, and especially looking at interest rates, which are still hovering around zero on a short-term basis for the pristine paper. I'd have to say that the deflationary outlook is still well intact, and the central banks did quite a job of keeping things relatively inflated ever since 2000, and especially since the real peak in debt in 2006 to 2008, but I think eventually they're going to lose. I think 6 billion people on Earth turning into a different frame of mind is going to overwhelm their abilities.
Yeah. You know, in a deflationary environment, I think one would expect the dollar to be the big winner. But, you know, the dollar really hasn't been doing much. You know, if you look at the dollar index, it's only about just around in the low 80s. So it's essentially in a trend or a sideways trading range, no different from where it was back, in 2005, 2006. We had the dollar rally in 2008. We've had a bit of a bounce here. Isn't the fact that the dollar is not responding an indication that maybe really deflation is not in the cards?
Well, I think it's a pretty incredible feat that the dollar is not making new lows and is going sideways when we've had record debt creation and money printing by the Federal Reserve. We had QE0 in 2008 where they added $1 trillion to their balance sheet. We've had QE1, QE2, threats of QE3, and yet the dollar refuses to go down. So I would say with the wind at their backs, which has been the case for the past 10 years, it's pretty amazing that over the last 4 years there hasn't been any further deterioration of the dollar. But I will say this, The dollar, when you talk about the dollar, for example, the dollar index or the dollar relative to the euro, we're only talking about relationships among currencies. And I think all of the major currencies of the world are going to have serious deflations. It's very possible that they could all have a terrific deflationary collapse in terms of the amount of credit that's still good out there in the world. And most of the currencies could end up at the end of it, when the dust clears, just about the same relationships they are today. But I've been saying all along that there are more dollars out there, more debts denominated in dollars. So I think the deflation there will be more serious, and therefore the dollar nominally will probably perform better than the other currencies. But that's kind of a gamble and a guess. But what do you see going forward? You're looking at everything very carefully. You've got your indicators as well, and I know you're on the inflationary side. So what are you seeing that you like on that side?
Well, I'm actually on the hyperinflationary side, and
right.
the reason why I say that is that hyperinflation manifests itself in two different ways. They either print paper currency, or they create more zeros in bank checking accounts. When you look at Weimar Germany and Zimbabwe, they had a paper currency hyperinflation, and the reason why they had those is very few people had bank accounts. The banking system was not very sophisticated. Even government employees at the end of the month got paid in paper banknotes in a little pay packet. So when the governments in those countries started spending money and borrowing more than the market was willing to lend or could lend, the government either had to stop spending or turn to the central bank to give it the currency that it wanted to spend. And both the Reichsbank and the Zimbabwe Central Bank, started the printing presses and created all kinds of banknotes and had a tremendous hyperinflation. But if you look at Argentina back in 1991, it also had hyperinflation, but they weren't moving bushel baskets of currency around because Argentina had a very sophisticated banking system. Most people had bank accounts. When people were paid or most commerce was conducted, it was conducted by moving money around within the banking system. So when the Argentine government was spending too much money and borrowing, it turned to the central bank and asked the central bank to create currency, but they created deposit currency, not cash currency. So you had a deposit currency hyperinflation in Argentina. So given the similarity of the U.S. Sophisticated banking system with that of Argentina, I think we're going toward a deposit currency hyperinflation because, in my mind, Bob, the critical thing is that there's a huge gap between what the U.S. government is spending and what the U.S. government is receiving as revenue. In the normal circumstances, they would have to cut down spending to match their revenue. They're not doing that. They're turning to central banks and the banking system also to a certain extent, which is buying government paper, to create this deposit currency to allow the government to continue spending. So I'm on the side that suggests that we're actually going to go to hyperinflation. And there's one chart that I like to use to suggest that as well. If you look at the gold chart going back to the beginning of the decade and look at it on a log scale, regardless of what currency you look at it, you're actually seeing a parabola form on a log scale chart, which suggests that the gold price has the potential to go exponential, which is what you would expect in a hyperinflation. So despite all of the credit destruction and wealth destruction and destruction of financial assets, which I must admit does have the appearances of deflation, when it comes to currency itself, I'm expecting a hyperinflation.
Well, if we get hyperinflation, you're going to have to see interest rates rise, I would assume. And I also believe that ultimately is going to choke off what they're trying to do. I think there are also political barriers to hyperinflating and super borrowing from the government. We've already seen the rise of many people, including in the Tea Party, for example, getting angry about government spending. And that hasn't been the case for a long time. I think there are going to be political, social, and other restraints that people are not taking into account. The Keynesians don't take into account. The monetarists don't take into account. They think the economy is a machine, and they don't realize that people get emotional, they get angry, they get upset. And that's what's happening in Europe. They thought, well, we can bail out all the countries we want. And now they're realizing they can't. It's a bottomless pit. And the producing nations, such as Germany, are the ones ending up in the short end of the stick. And guess what? Even the nations that are spending their heads off are ending up in poverty. They've got unemployment up in double digits, very solid double digits, and getting worse. is just going to lead to, I think, a complete repudiation of all the IOUs out there. And I think that'll be far swifter than any response they can generate, particularly in that political environment. But there's enough balance, I think, in all these markets to allow either scenario to work out from this point. Yeah. So I think we'll just have to wait and see.
Let me ask you a question. In a deflationary environment, the demand for the currency tends to rise because people believe that the currency is going to have greater purchasing power in a deflation going forward in the future. But what if the demand for currency doesn't arise because of all of the concerns about, the quality of the currency, the quality of the banking system? I mean, even the central banks and the European Central Bank itself, its solvency is being called into question here in Europe. So why would people rush into the euro and cause a deflation by, rising demand for the currency?
Well, I have never said that I thought people would rush into cash. What I'm saying is that there will be a collapse in outstanding IOU values. And that means all this debt that's out there, trillions and trillions of dollars worth, 60 trillion by one measure, 600 trillion by another, is just simply going to collapse in terms of its value. In other words, people are going to say, this stuff is worthless. Nobody's going to pay me back. Nothing with any kind of value. And already people have realized that the Greek debt fell in that category. I mean, what did they do? They didn't print their way out of it. They actually defaulted on a huge amount of it. Yeah. So I think that's the future. And what remains, whatever surviving dollars and euros there are, which in my view will only be the ones you can stuff in your wallet, plus maybe a few IOUs from very solid corporations, are going to be the only, dollar-denominated currency or debt assets available. So it's more like by default. But in terms of demand for money, a lot of people recall in Germany, as soon as someone got paid in the manner you talked about, what did they do? They rushed out and spent it as fast as they could. But today, in America, people are actually trying to hold on to whatever money they have. Except for once, one quarter recently, they've been actually shrinking the amount of consumer debt, except in the area of college loans. And look at the people that are just desperate for jobs. They want to get a hold of dollars in any way they can, and they're having extreme difficulty doing it. The government's trying to paper over it with unemployment checks, but that's not going to work. They're taking it from producers and giving it to people who aren't producing. That's all part and parcel of the depression that's coming. They're doing everything possible wrong.
Yeah, no, I agree with you.
I'm sure we'll agree on that.
Yeah, no, I agree completely with you on that. They are definitely going the wrong way. And unless we come back to basics, and of course, sound money and the rule of law are two most basic elements of it, we're going to continue going in the wrong direction.
Yeah, we've set up this situation, or the government did in 1913, where they, by law, established what I think was a non-constitutional idea, which is a monopoly on banking that gave favors to the government, and it's all based, instead of being based on money, in other words, gold, it was based on debt. So this brings me around to a question I've always wanted to ask you. What prompted you to create something that sounds new, but is really as old as the hills, non-debt banking?
Really, basically, just a study of monetary history. My hobby is collecting and reading books on money and banking. I've got 3,000 books in my library on a history of currency, the history of gold, the history of silver, history of banking. And it seemed inevitable to me from the reading that I did that this experiment with fiat currency would eventually fall apart, and that gold's 5,000-year history of money would ultimately, win out, just like it's done at so many other times in the past when there have been financial crises.
Oh, we totally agree on that. I think fiat money will be in the history books sometime in the next 100 years.
Yeah, and gold will still be there in the center of global commerce. Yeah, but how we get from here to there, I guess, is the question we really have to deal with. And, there's still a lot of uncertainty. Before we get into the gold, I want to talk to you about, gold and silver. Just one thing that is a conundrum. We're talking about a deflation, and in the U.S., the point you're making about increasing hoarding of dollars because people want to get liquid, et cetera. Yet inflation in the United States continues to rise, even by the government's own statistics, which I think understate, the true rate of inflation or loss of dollar purchasing power. How do you explain that conundrum?
I don't think they're taking into account the phenomenal loss of what people thought they had as wealth in the value of their homes. That's almost every family in the United States has some kind of connection. Well, let's say 2/3 of them anyway own a house or a condo or something like that, and those prices have just been crushed. And this does not surprise me. I think what's happened in the real estate market worldwide, pretty much, but we'll focus on the United States for now, is a microcosm and a flash forward of what we're going to see throughout the entire debt structure of the world. In other words, these investment values collapsing, crashing, and being unable to recover. We're reading a few stories now about how people are saying the housing market's recovering, but it's not, and there's still tremendous number of homes that are foreclosed and need to be sold, and they've been holding them back from the marketplace, but they'll be out there eventually. So, yeah, some of the consumer prices have gone up. Consumer prices, as you know, lag. They're the last ones to roll over. But part of it is because we've been in a reflationary 3-year period. So even though we went, I think PPI and CPI both went negative in late 08, early 09, but the central banks and I think natural cycles, I mean, I got bullish in late February 2009 because we completed an Elliott wave pattern, a beautiful 5-wave decline. So I said we need a very big bear market rally. All of that's been on schedule, so I'm not that surprised that some prices are holding up, especially investment prices or stock prices, because that's where most of the free money offered by the Fed has been going. And then it goes into hedge funds and they leverage it up 30 times. No wonder the stock market is holding up. But when that leveraging goes in the other direction and begins to deleverage, I think it's going to be a sight to see. Yeah. I think we're going to see the Dow drop thousands of points before it's over.
So what do people do to prepare for that?
Well, what I've been saying is you want to be in absolutely no standard investments. You don't want stocks. You don't want bonds, especially municipal bonds or junk bonds, but just about any type. You want cash equivalents, both here and in some cases abroad, and you want your store of gold and silver in a nice, safe place. And you wait, because the great buying opportunities of all time have occurred after debt collapses, whether you're talking about 1859 or 1932. And I think another one of those great opportunities is coming up. And it's very tough to decide, as you well know, exactly what do you hold to take the maximum advantage of things. I think gold, of course, is a timeless store of value, but relative to these currencies, I think there's going to be some pretty wild fluctuation. But the great thing about, I've said positive things about GoldMoney in the past, and the thing I like about it the best is that it allows a person to escape the debt-based money system. And even though currency values are going to fluctuate wildly, which will appear to be gold fluctuating wildly, but it won't be, as long as you have a pure money option, you can just opt out and say, I'm not going to play, and I don't want to be a speculator and try to figure it all out.
Yeah, so the key is what you do is you get liquid and let everything fall apart until we get to that stage when the last excesses of the system have been wrung out. And then you use your liquidity to invest in the next cycle. Is that what you're basically saying?
Yeah, and when we bottomed in 1932, stocks bottomed in July, silver bottomed in December. Commodities, of course, had a very strong run-up along with stocks in the first 5 years of the bull market from 1932 to 1937. So I think you can invest in just about anything at the low. But if you're money-oriented and you're worried about the social unrest that's going to be occurring at that time, I would probably use that opportunity to buy gold. But if you're a long-term person, you definitely want to scoop up some real estate at 5 cents on the dollar, in coastal areas, something like that, or your dream house. And if you're a speculator, maybe you buy some commodities. But I'm pretty simple when it comes to all this. I don't think most people are that sophisticated. They should have, at the bottom, they should be in real money, and they should be in property, and probably a lot of stocks that survive, at 5 cents a share.
Yeah, we're seeing social unrest here in Europe. Even in, I'm sure in the television in the States, you see the various protests, occasional riots, and things of that nature. Is it likely to see similar social unrest in the U.S. in your view?
We haven't seen anything yet. I think unemployment is going to go past 1/3. It could even at the bottom hit a half of the country if they tally it properly and don't try to hide it as they do now. And can you imagine, with so many people with nothing to lose? I think it's going to be a very, very dangerous place at the bottom. We've got an entitlement generation, unlike the generation that suffered through the Great Depression. People are used to having their unemployment taken care of, and their Social Security is coming, and my Medicare is going to take care of me. And I think those things are going away. So it's going to be very difficult. And I think people shouldn't just think about where their money is; they should think about where they are.
Yeah, in the 30s, it was still very much an agricultural economy and a lot of self-sufficiency. That self-sufficiency has largely disappeared in today's economy.
Well, let me ask you a question. Since you brought up social unrest, the only part about gold money that I think is a little bit disconcerting is that there is a hoard held somewhere, and I suppose that could always be the target of extreme political forces. Are they going to try to steal it someday? I know you have a couple of different vaults.
Yeah, it's really a good question, because at the end of the day, you really don't know the future, but you do know that gold is an asset that governments are going to want if they end up breaking the law and confiscate that. So what you really
breaking the law? The government never does that.
So what you really want to do is diversify as much as you possibly can from a practical point of view. Geographic diversification makes sense. Different parts of the world, in case a war breaks out in one part, you don't want to have your gold, all at risk in case of a war. But also you want to be in different political jurisdictions in case one political jurisdiction starts confiscating assets. For example, Argentina. If you had all of your wealth in Argentina presently, you'd probably be regretting it because of the various policies that the Argentinian government has been imposing to try to keep capital flight and keep their system of government, socialist government going. But it's fraying at the edges. So I guess the key really is that in an uncertain and unpredictable future, geographic diversification is one way to protect yourself. So I'm really a supporter of physical gold, regardless how you own it. And there are basically only two ways. You buy it and you store it yourself, or you buy it and have someone store it for you, which is, of course, what we do in GoldMoney. But if you do that second option, you want to be certain that who you're storing it with, has the same types of governance issues and policies and procedures that we do in GoldMoney in terms of audits, double checking, and things of that nature, so that your gold is safe.
Yeah,
but keep in mind. Yeah, I was going to say, keep in mind there's a bigger pool of gold out there, or silver for that matter, in terms of the ETFs. So if you're going to be confiscating, it's more likely they're going to go after the ETFs rather than private hoards and private companies. Would be my guess.
I tend to agree, and one of the things I liked, and I mentioned in my book, was if you have your money with gold money and you're in one of those dicey countries where you have to get out, they're not going to let you get out without leaving all your money behind. And in your head is your GoldMoney account, and they don't make you give that up as you leave. That's a pretty good asset to have with you. You don't have to try to figure out how to get your money across the border. For example, you just leave, and wherever you set up shop, you've still got your account.
Yeah, that's one of the beauties of GoldMoney. You put your gold in GoldMoney, and then you can wire the proceeds if you want to sell some of your gold or silver to your bank account anywhere you are in the world. So it gives you a lot of additional flexibility.
Well, the old saying, I don't spread everything around. I put my eggs in one basket, and then I really watch the basket. Yeah. I guess that's your job. And in other words, if you have a couple of vaults, you want to keep really close eye on on the legal proceedings and the political events in the jurisdiction where you're holding it. And I suppose you'd have to be ahead of any really bad news in that geographical area and physically move your stock.
Yeah, exactly. And the countries that we chose, they all have good solid histories. London has not confiscated gold since Charles II did it in 1663. Zurich, to my knowledge, has never confiscated gold. Hong Kong, the third vault, it was confiscated when the Red Chinese Army moved in 1948. But that's likely to be happening anytime soon. So I think
those are good choices.
The good jurisdictions, and over time we'll be adding additional jurisdictions as well as our customers
right. And if one of them changes for any of the myriad reasons that can happen, you've got the other two or more that you can shift the gold to.
Absolutely, and you can always take delivery of your gold from GoldMoney at any time, even if you don't want to shift it from one vault to another. Just take delivery of it.
So, are customers having problem translating to grams and mils?
No, it's very easy with a computer because we show ounces as well as grams. It's interesting, in the Anglo-Saxon world, people talk in terms of ounces when they're talking about gold, but the rest of the world is pretty much a gram-based and metric system based as to how they view gold. So we really cater to both. Yeah,
that change has been a long time coming. In the States, you still have to buy two sets of tools.
Yeah, absolutely. Well, Bob, it's been a real pleasure chatting with you. Do you have any other
I'm glad you
questions?
Came out of semi-retirement for a chat.
Yeah, no, happy to do it. Any other questions about GoldMoney?
No, but I guess one more observation. Money is supposed to satisfy three things: be a unit of account, an item of final payment, and a store of value. And most of the fiat currencies of the world are trying to be the first two. Let's account in this, and that's how you have to pay your taxes. So we force you to account in that unit. It's final payment. It's not that satisfactory though because of the third thing, which is the store of value thing. And I really believe that we have turned the tide from the most expansive monetary and financial investment experiment in the history of the world. I think psychology is changing toward conservatism in that entire area. It's going to take a decade or two to play out, but that's when people, I think, are finally going to realize that the store of value part of what money is supposed to be is suddenly going to become a whole lot more important to them than they ever thought about.
Yeah, I agree with you. And I guess to put it in, from a deflationary perspective, if prices of everything goes down, the price of gold will go down less, meaning your purchasing power will still be preserved in gold. Would you agree with that?
I've said that many times. Yep.
Yeah. So you're better off holding gold, and if you're happy with some currencies as well, I guess is the way you're looking at it in order to achieve that liquidity for the ultimate bottom. Yeah,
you'll be better off holding gold, I think, than stocks, most bonds, commodities, or even real estate. Those are going to be the worst, and those are the ones that almost everyone else is recommending. And all I'm saying is you want money. Now, money is a somewhat debatable idea these days as to what it exactly is, and that's why I've somewhat diversified into money, but only into money.
Okay, understood. Bob, thank you very much. It's been a real pleasure chatting with you.
Absolutely. We'll do it again sometime.
I'd like to do that. Thank you again.
Subscribe to the GoldMoney newsletter at www.goldmoney.com to receive email updates on new articles, videos, and iTunes podcasts from our Gold Research section.